I'm a 38-year-old Singaporean 9 to 6 worker living in HDB's simple lifestyle with no car. Here, I document my journey towards a $4.5 million retirement goal by age 50. The portfolio sits at $591k $499 so far, with more than half composed of profits at $313k in gains after 4 plus years of investing. I have 12 more years to go for a total of 16 years of investing. Now, in spite of all the volatility last number of years with the Fed rate hikes, the Trump tariff wars and the Middle Eastern war, my portfolio has outperformed the S&P by 104.7% in gains, equating to an extra $237k dollars compared to if the same amount of money were invested in the S&P instead. Since the portfolio's inception, annualized performance is 24.76% per annum, beating the S&P, which did 10.28% per annum, more than doubling the market index. Now, today I'm going to talk about 3 portfolio types that suit different kinds of Singaporeans, such as young people with at least maybe 10 to 15 years investment horizon, old folks nearing retirement, busy working professionals like doctors, lawyers, bankers, teachers, and people who are emotional and fear volatility or Kiasi. And I'll also introduce briefly how to start building each portfolio and the underlying philosophies behind each portfolio type to give you a head start in exploring the style that suits you the most. Now, the most popular portfolio of all is buying a low-cost diversified index such as the S&P. And the construction is very simple. Firstly, it's to consider Irish domiciled S&P 500 ETFs called UCITS, like the CSPX, which has lower dividend tax and is estate tax exempt for Singaporeans, which means even if you die, you don't have to give 40% of your proceeds to the US government. The CSPX is accumulating, so dividends that are paid out will auto reinvest back into the fund so you can compound faster. Now, there are other types of UCITS, but I will leave it to you to look deeper into this. And there are 2 ways to get started. First is to inject a lump sum. If you happen to huat big, you got inheritance, or obviously for the more common folk, you have savings that you've been building for quite a while and you put it as a lump sum into the market. This is sort of the first method. The second, which is more common, is to dollar cost average or DCA by investing a fixed monthly account into the index. Now, historically, lump sum actually beats DCA on average. But for most regular Singaporeans, DCAing is the easiest because we receive month-to-month paychecks and can treat it as a sort of fixed savings plan. And the goal of this portfolio is to get the average market return by riding on the backs of the 500 strongest US businesses over the long term. And I like to use at least a 15-year median rolling returns with inflation adjusted to be conservative. And that comes to about 6 to 7%. And although this market return is very small, the S&P 500 actually beats 90% of professional funds over the long term of at least a decade without any complicated science. And I tell you something, most professional funds, right, they will never admit this. But it is the truth, and it is almost unintuitive because simplicity can in fact beat complexity or fancy sounding techniques. S&P 500 indexing is suitable for younger people with at least 10 to 15 years investing horizon because it is growth oriented and you need time for the average returns to play out. And indexing is suitable for busy professionals like doctors, lawyers, teachers, or just people who have tiring day jobs and they don't have time to research individual companies and just want the investments to be autopilot. Now, it does require a reasonable temperament where you should not get too affected by the stock market's volatilities and some discipline. Because there is a caveat, okay? You should look to DCA consistently through both good times and bad times. And so at this point, some of you will say, yala, I can tahan volatility, no problem one. But you might say this because you looked at the market's recent outperformance in 2023 and 2024, and then you FOMO, you want to enter the markets now in 2025 because of the recency and hindsight bias. Now, if you belong to this group, let me ask you a question. Why weren't you interested in investing in 2022? Or Or why didn't you maintain your DCA through 2022 when the market was crashing? Why did you wait until now in 2025 after you saw two bullish green years to begin considering investing or to resume your DCA if you had paused it? If you were DCAing into the index, your plan should have remained unchanged in 2022 and you should have invested every month without fail, especially when the market was tanking. In fact, you should feel happy in 2022 as the stock market tanked because you were DCAing into lower and lower prices. Now, if you did not feel this way and you only felt FOMO now today in 2025, I have to give you one brutal advice. Stop watching my video right now. You don't have to give me more view time, guys, because I believe you do not have the temperament nor the discipline for the stock market. Any guru that tells you that the market will always quite big without market crashes is selling you koyok water, sunshine, rainbows, and white ponies. And if your reasoning is, drop in 2022, won't drop again one lah, then you only need to see what happened in 2018 when Donald Trump started the trade war with China and the S&P dipped by 20%. Or shortly after, 2020, you guys forgot the pandemic, 35% crash. Or just 2 years later, 2022, Jerome Powell hiked the Fed rates, crashing the market by 25%. And then this year, Trump introduced the tariffs again, sending the markets down 20%. So how sure are you a correction won't happen anytime soon? Nobody can predict the short term, and you should realistically expect many drops along the way and welcome these drops as part of your DCA. And I'm worried because we are starting to see Reddit threads like this on Singapore 5. Like this guy over here asking about the S&P, and then he says, I've heard people say this is pretty much guaranteed positive returns. And then he says, everyone else has earned a significant amount of money from investing into S&P, right? I'm just trying to do the same. And so, if you belong to this FOMO group who thinks that returns are guaranteed, and every year is a bullish year, you should not be investing because I suspect you won't even get the market's average of 6 to 7%, since you are likely to sell at the bottom and buy only at the top, when you should in fact be DCAing consistently irregardless of market conditions. Because remember, like what Turtle Tyson said, everyone has a plan, everything sounds good until you get punched in the face. Okay, now that I've destroyed your fluffy dreams about stock investing, I'm going to carry on. Now, there are many variations of indexing. For example, Mr. Lu of the 1M65 movement, he does this blended index strategy where a majority of his holdings are S&P 500 and the minority is QQQ. And if I remember correctly, he does something like a 80-20 ratio. And there is some overlap in the underlying holdings, but I can appreciate where he is coming from with this strategy in terms of getting a bit more growth from QQQ, yet having a stable base with the S&P. And Mr. Lu also does something called crash buying, which is that he accumulates cash and only deploys in lump sum into the index during downturns like 2022. This is a bit timing the market, and I don't think it's for everyone because it does require a bit of knowledge. So I think you're better off DCAing robotically to get the market average return. Now, there are some investors that say, I don't want an S&P, it's just so US focused. And maybe you prefer a more globally diversified index apart from the S&P 500. And for this group of people, I'll say, okay, maybe you can look into other Irish domicile UCITS like VWRA or IWDA. There might be something for you to explore. And there's this Singaporean guy called Dr. Wealth. He wrote actually quite a nice piece on world ETFs. And I've actually put it in the description below. I am not affiliated with that site, but I do personally read some of the articles there when reading about index investing, and I think they are quite helpful. And there is also a different class of people that we call the Boglehead style of investing. And actually, it mixes different indexes together, sometimes even with bonds. So this might be suitable for more risk-averse people or older people nearing retirement who still want some growth, but in a more stable fashion. So this is something that I think you can go and Google or ChatGPT to read up on in detail, this Boglehead style of investing. Next, we come to my territory, which is the growth style portfolio. Now, there are a few types of growth companies to construct a portfolio with, and I personally like to use Peter Lynch's framework of categorizing growth companies. And the first type of growth company is what we call the stalwarts, which are established, stable companies that are experiencing moderate growth in earnings, and they're usually large caps like McDonald's, P&G, Visa, MasterCard, which are more defensive in nature. Now, the second type is what we call the fast grower that has much higher earnings growth but higher risks like Meta and Exxon. And the way that you allocate the percentage compositions between stalwarts and fast growers in a growth portfolio comes down to your circle of competence, your time horizon for investing, and very importantly, your temperament. Now, stalwarts generally have a smoother growth because they are generally mature, proven winners, generating consistent cash flows over a long time, and so it is comparatively less volatile and more predictable than fast growers. Fast growers are more risky and volatile. So, for example, in 2022, Meta actually dropped 75% from a price of $380 to $90. So, if your portfolio is comprised of mostly fast growers, be mentally prepared that more than half of your portfolio value is going to go poof during your investing journey. And this is also why, if your portfolio comprises mostly fast growers, you will likely need a longer time horizon than if it were mostly stalwarts to allow more time for recovery after potential sharp drops, mitigating some of the sequence of return risks. So, for example, let's say you intend to retire in 10 years and you hold mostly fast growers. Your portfolio year 1, year 2, year 3, all the way until the ninth year, the first 9 years, everything was perfect, green, bullish, or generally okay, moderate growth, right? Everything's okay. And then you sway garner a bad sequence where the 10th year of the stock collapses maybe 50%. How you retire? It's not worth it for you to sell the portfolio at this point to begin retirement consumption. And this is why for myself, because most of my portfolio comprises fast growers with a portion of my watch list being stalwarts like Visa and MasterCard, my overall investing horizon is 16 years at the minimum. Even then, I am mentally prepared to adjust my financial independence age of 50 by a few more years if needed, in case I get hit by a bad string of years closer to retirement. And these are things you cannot control, guys. You cannot expect Mr. Market and all the stars to align sweet beautifully to your retirement plan. That is impossible. Okay. Now, the portfolio size is another factor to consider. For example, Adam Khoo, a very well-known Singaporean investor running a multi-million dollar portfolio, he runs approximately 40 stocks in his growth portfolio, which means if you divide it 100% divided by 40, he assigns approximately 2.5% per stock. And when he reaches that full allocation, he stops topping up and just lets the position run by itself. I like to refer to this style as a sort of VC style of investing because what you're essentially doing is you are spreading your seeds across a large surface area of companies, and a few of these companies will far outperform the rest and carry the portfolio because most of the time, the majority of the positions, they will perform, but they're either mediocre or they are not bad, but they will not be super outstanding. So there will always be that small group of stocks in the large portfolio in this VC style that will really carry the whole portfolio up. And I must stress that this portfolio game, right, it is a game of probabilities. It is impossible for all 40 of the positions, right, to what big one. It's impossible one. It cannot be possible. Nobody can be godlike like that. Even for my style, if we look at my portfolio that is concentrated, small number of positions, it is very clear that I have only one outperformer, which is 20%, because it's 1 out of 5, right, in my portfolio, which is Netflix. And the focus portfolio that I have is something I do not recommend anyone to follow, this concentration, because it is highly volatile with only 5 companies that are all fast growers. Over time, my portfolio will go up to no more than 10 to 12 companies that are my best ideas. Now, a small portfolio requires a lot of emotional control, and it looks good on paper. In the last 4-5 years, wow, everything very green. But if you follow my style, right, which is inspired by Charlie Munger, Lee Lu, Chris Hone, all these folks, it's a similar style that these people run in their concentrated portfolios. Let me tell you, you will be in for one hell of a ride. Now, for example, if you saw one of my older videos, I transparently shared that my portfolio dropped $105,000 following a 20% correction in less than 2 months. But during these 2 months, not only did I sleep like a baby, but I was damn happy because I got to buy more stocks at depressed prices as they crash. So you have to be a bit xiao, a bit psychopathic, because you have to behave completely different from how a normal human being behaves emotionally if you want to follow this path of a concentrated portfolio. You have to be emotionally immune to volatility. Most people say, I can do it lah, only because they FOMO and they see the green stuff or the bullish stuff. But then when the shit hits the fan, all these people run away. I tell you, more than 90% of people that I hear that say they can do it really cannot do it one. So I highly discourage my style of investing. Surprisingly, even though this is my channel, I highly discourage guys. Okay, but I know maybe there are some small groups of it. If you really, really want to know a bit about my investing process, right? You want to know what I constantly think about my positions. I have left the link below in the YouTube description to my Patreon Discord community, where I share my investment memos in deeper detail inside the Discord server. I think there's only about 60 or 70 people inside. I haven't really kept track. I don't expect this community to go very big. I know some of these communities, they have like thousands of people or whatever. Because the truth is, right, I do not buy a stock every day or every week. Yes, you heard me correct. So I know a lot of people, right? Most people, when they hear, I got this community or this subscription, what they're hoping to do when they subscribe is they hope to copy, trade, and try to replicate some of the trades that these investors are executing without doing their own due diligence. And so normally you expect to see frequent buy alerts so that you can keep copying like every day, every week. You get, send a lot of these kind of alerts and you feel very shocked. But if you belong to this group of people, please don't join my total community. You'll be wasting 12 Sing dollar per month or 2 cai per head fish, okay? Because you're only going to see a buy order from me, right? Maybe once every few months. I'm serious. And for the rest of the time, right, what I'm just doing is that I'm just doing my stock research. I will list down some of the research I do in the community, my buy levels, my valuation techniques. I will share with some observations of the industry and some companies, especially within my circle of competence, which is technology, because I work as a solutions engineer in a big tech company in North America. So I really focus on that core competence and I share my notes. And all I'm doing, right, if you're in the server, right, is you will see me, I'm just waiting. Really, I'm just waiting and waiting. And I only enter big with a fat pitch on depressed prices and pessimism, which takes a lot of waiting. So especially in times like today, when the market is all-time high, you see that my portfolio and the general S&P in the market and all, everything all-time high, right? It's going to take quite a while before my next buy opportunity. I really can feel it already. So if you're someone that wants to be given a fish every day or every week instead of learning to fish, you're the kind that likes adrenaline or having your fingers always on the trigger, ready to copy trade stocks in and out. Sorry, you all don't join my community. You will not be a right fit. You waste $12, okay? But if you really want to start, sort of slowly learning the way that I select criteria, my stocks, my investing framework, my philosophy, or if you just want to ask me direct questions, about general personal finance, how I run my life, general career stuff in technology, or like just my investing philosophy, then I welcome you. You can feel free to join. But anyway, I digress. Now there are of course different growth companies in Europe, India, different parts of the world. But what I found is that most of the high quality growth companies tend to be in the US or China because they tend to be more international and have a larger total addressable market for growth. So for example, Netflix sells not only to the US, but to the rest of the world. Like you see Squid Game just got released, right? I'm sure not only people in the US are watching. People like here in Singapore, we are also watching. People in, Europe are also watching. And so if you compare that to some of our local companies in Singapore or Malaysia, most of the time, the products that these companies, our local companies sell, mainly target Southeast Asia or at best China. So the growth runway and the TAM, the total addressable market, is shorter and smaller. Now, the selection criteria for growth varies between investors. Everyone has their own way of selecting companies. For myself, I have 9 criteria I look at before I even shortlist a company. And that includes things like circle of competence. For example, for myself, is technology and luxury. Surprisingly, that's another story for another day. Things like a competitive, durable moat, consistently growing revenues or cash flows, management capability and integrity, valuation, and more. And for valuation, the way that I look at adding stalwarts versus fast growers in terms of proportion is that I am more stringent and require a greater drop in prices before I even consider adding a stalwart. And the reason for that is because I am compensating for the slower, longer term growth of a stalwart compared to a fast grower by juicing some of the returns at the beginning with a larger dip in prices that I require from a stalwart before I buy. So in a way, you can say that the rough CAGR I would roughly get between a stalwart and a fast grower is quite comparable because of this more stringent requirement before I add a stalwart. Now the problem is because it is so strict, these kind of opportunities are very rare to come by. So for example, I have been waiting for a company like Hermes for almost 2 years now, and I haven't bought a single share. I really love this company and I hope that I can buy it at the right price. So I hope maybe this year might be the year, but we will see. And their earnings report is coming next month, I think in July. So I'm really looking forward to that. And their price seems to be trending down. So hopefully there's an opportunity coming. So yes, in summary, I can patiently wait for a few years, doing absolutely jack all, nothing at all. Don't sell, don't buy, nothing at all. My portfolio is just not there sitting. Until an opportunity appears when I go in, and I go in big with a fat pitch. Of course, there's this whole other topic of cash drag where there's opportunity costs. But for the opportunities that I'm waiting for, usually most of the time, the amount of time that I'm waiting more can be compensated with the opportunity itself. Now, the goal of a growth portfolio is to very simply beat the market return over at least 10 years. Because if you're not beating the market, to be honest, you might as well not waste time. You guys wasting time, researching and monitoring stocks, and you end up the same performance as DCAing into the index, or maybe even less than that, which is very possible, right? A lot of people over-engineer their portfolio and end up they just underperform the index, which is very stupid lah. So then you might as well just DCA index, and there's nothing wrong with that, because to beat the S&P 500 over 10 years, right? You can consider yourself a top 10% investor. 90% of people fail to do that. Most people they will shout about their gains 1, 2, 5 years, and myself included, by the way. But over a longer span of a decade, most people do not beat the S&P 500. That is the brutal truth. So the S&P 500 as a benchmark is the most difficult to beat long term, and I think it is the most appropriate one that you can measure against when you're running a growth portfolio. So I'm only about 4 to 5 years into my journey. Even though I've beaten the market so far, as I've said, I consider myself an unproven investor until I reach the 10-year mark. And this is the thing about investing. We cannot accelerate the passage of time by 10 years suddenly, like a time machine. You just have to patiently suck time and wait for a decade before you know whether you have been lucky or whether you truly have skill. Now, it is important also to realize that a growth portfolio, right, does not rely on dividends for performance. Instead, growth investors like myself, we focus more on capital growth. So for example, if you look at my portfolio gains over the last number of years, only 1.4k out of over 300k profits, right, was from dividends, which is almost negligible. But for many Singaporeans or Malaysian investors, this idea of relying on capital growth, right, is one of the hardest abstract concepts to grasp, because many are used to this idea of investing in a local company like DBS, UOB, and then you expect a steady stream of dividend payout income to the investor. So for many local investors, they fail this part of the emotional abstract criteria because they demand a guaranteed dividend payout instead of focusing on long-term capital growth and total returns. Now, if you belong to this group, I strongly discourage you from even considering a growth portfolio. But if you're someone that can delay gratification, be emotionally disciplined for 10, 15 years and more, and obviously you have to pick the right winners within your circle of competence at the right price, then you will produce extraordinary returns. Like one of my viewers here who sent me his growth portfolio that he held for 19 years, that hit about 11.5 million Sing dollars in value, of which 9.8 million were profits, which means 88% of his portfolio was from profits, not contributions, and that should be the way. Now, the key here is that he barely sold any shares throughout all the wild volatilities of his growth portfolio over nearly 2 decades. And this sounds damn juicy and exciting. Most people, they feel damn giddy when they look at all these returns. But let me tell you, most people will never have the emotional discipline to not sell out positions in times of fear or in times of greed and overvaluation. So I really applaud this viewer. Now, in terms of suitability, I think it is better if you are young and below age 45 before considering a pure growth oriented portfolio because you really want a long horizon of, I'd say, at least 15 to 20 years to ride through the volatility that will be much higher than the index. Lifestyle wise, you cannot be a busy professional because you need time to research stocks, monitor them by reading the earnings call, watching industry trends, and constantly studying your companies for any changes on the horizon. It is a lot of work, but personally for myself, I love it. And I don't see it as work, but I see it more as a passion. Finally, you need to be almost like a robot, discipline wise and emotionally, to execute well on a highly volatile pure growth portfolio. This style of portfolio is the hardest to execute, but if you do it, the long term rewards, as you've seen over the 15 to 20 years horizon, will be the highest. Hey, by the way, guys, if you like the content so far, remember to give the channel a bit of turtle power and click subscribe so you can be informed when I push out new content. Anyway, back to this episode. Next, we have our final and all-time favorite here in Singapore, the dividend portfolio. I can already imagine many of your eyes lighting up as you hear the word dividends because you're thinking, wow, dividends free money Coconut water falls straight into my mouth while sun tanning on the beach. But remember, there is no free lunch in the world, especially when it comes to investing. I think a deep dive into the illusions of dividends is a subject for another day. But that being said, there are successful case studies which I shall talk about shortly. Now, building a dividend income portfolio is quite straightforward. What you're really looking for are stable and mature companies that have been consistently profitable in terms of income or cash flows over a number of years, such as our local banks or REITs like CapitaLand, etc. Now, the beauty of investing in local or Hong Kong-based companies for dividends is that you are exempt from dividend tax as a Singaporean. Whereas if you invest in the US for dividends, right, you're going to get slapped by a 30% withholding tax. So most people who invest in the US, right, they don't really focus on dividends, but they focus more on capital appreciation. Because as a Singaporean, that is the beauty. Capital appreciation, right, when you buy US stocks, you are not taxed. If you make capital growth, it's 0%. So that's why if you want growth, you go US. You want dividends, play local or play Hong Kong. But just by the tax alone, that's really a big factor. Now, strong dividend paying companies should produce at least, in my opinion, a 5% yield. And obviously, this has other factors like what is the price that you bought it at? It has to be a good price. And even the current price, if it can be 5% at minimum, that will be good. And obviously, it has to demonstrate consistently rising dividends per share over 5 or more years and have a sustainable dividend payout ratio of less than 100%. And of course, the lower this percent payout ratio is, the better, because you don't want a case where a company is financially engineering dividends to make the stock look like a good investment. But inside, the company is actually rotting. It is issuing debt to sustain growing dividends and appearing like it's a great investment. What you really want is to make sure there is organic growth of dividends, which is supported by growing cash flows over time. So you know that your dividend stream is durable long term and not for show. Now, the case study that stands out the most to me is this guy called AK71, who collects about 200k in dividends per year. He was a regular 9 to 6 working Singaporean. He lived a very frugal life, and then he slowly compounded his wealth through dividend investing and then reinvesting the dividends that he earned back into the portfolio, and he's now retired. So he runs a blog, and also he frequently appears on YouTube, so you guys should check him out if you're interested in dividends. The goal of a dividend income portfolio is to generate a stream of steady income that doesn't necessarily have to beat the market return. It's possible if you reinvest and obviously you buy at good prices. But it is really more about dividend focus and less emphasis on capital growth. Capital growth is a bonus, if you can get it, great lah, but more, is about the income. Now, this means that in terms of suitability, I would say that generally any age you can consider this form of investment, especially if you're old, nearing retirement, and have less time horizon for growth stocks. Because dividend paying stocks can provide a stable stream of income for consumption. And technically, if you just consume the dividends and leave the capital intact, there will still be some capital growth in your portfolio, assuming you pick the right companies. Even for myself, as I approach the end of my growth investment journey after 16 years when I turned 50, one of my plans is to consider divesting my growth portfolio into a minimum 4% dividend yield pot, which is how I ended up with the 4.5 million target at 50. And alternatively, I might do a hybrid mix between growth and maybe an income dividend portfolio. But that will require some tweaking where I sell small pieces of my growth stocks when the valuation is high and I need extra money, maybe above and beyond whatever the income the dividend portfolio can provide. So this is more of a hybrid approach. But it is still very early to be honest. So I'll see what the situation is 10 years from now. What if I got, sequence of return risks and stuff like that? I need longer time for the growth to play out. These things can really happen, right? Lifestyle wise, I think it still requires some free time and passion to study companies. And of course, if you are focused on just the stable local banks, then generally they are quite safe. Never say never. You might not need much research apart from ensuring that the fundamentals haven't detracted too much and that you are getting good valuation prices when topping up your positions. Again, you should check out the AK71 guy because he's a master at this dividend portfolio. Finally, in terms of temperament, if you're the kind that is very kiasi, prefer to see a steady, fixed sort of income coming in, composed of stable companies, then yes, I think this will be more suitable for you. Because remember, even if the company falls in share price, as long as you are not selling out of panic, you know that you're still getting a steady stream of income for consumption through dividends. So it's not that bad. However, there are of course exceptions. For example, during the pandemic, when Temasek stopped the banks from paying out dividends to be more conservative, which to be fair, I think was a good and prudent move in the long-term scheme of things. So yeah, these are some caveats that you should take note of. But anyway, I hope you guys enjoyed today's episode. And hopefully you have a flavor of what kind of portfolio suits your style. I'll see you guys in the next episode. Thank you.